Welcome to The Explainer. Today, we're cracking open the Trader's Toolkit. We're going to look at the high-power tools that can build wealth, the blueprints that guide your decisions, and maybe most importantly, the safety manual that's going to keep you in the game. Okay, before we even plug anything in, let's start with the most important rule in the entire safety manual. Matthew Tuttle of Tuttle Capital Management just puts it perfectly. Understanding risk management is the most important skill a retail trader can have. I mean, this single idea is the difference between building a career and just flaming out fast. We'll definitely come back to this, but first, let's see those power tools.
All right, first up, the power tools. We're talking about the mechanics that let pretty much anyone, no matter their account size, get into the markets. And we're going to start with the most powerful, and let's be honest, the most dangerous tool of them all, leverage.
So, what is leverage? Put simply, it's a financial multiplier. It's a feature your broker offers that lets you control a way bigger position in the market than your account balance would normally allow. The key thing to remember here is that it magnifies everything. We're talking both your potential profits and your potential losses.
The amount of leverage you get is always shown as a ratio. For instance, a 100-to-1 leverage ratio, which is pretty common in the Forex world, means that for every single dollar in your account, you can control $100 in the market. You can think of it like putting down just 1% to control the whole shebang. So let's see how this math actually works in the real world. Imagine you want to control a $1 million currency position. Now with 50-to-1 leverage, you don't need $1 million. Not even close. You just divide the position size by your leverage. So 1 million divided by 50, and that means you only need to put up $20,000 of your own capital to control that entire position.
So what happens to that 20 grand? Well, it's not a fee you're paying or anything like that. It's called margin, and you can think of it as a good faith deposit that your broker holds onto while your trade is open. The second you close your position, that margin is released right back into your account, plus or minus whatever you made or lost on the trade.
So you've got the power tool in leverage. Now you need the blueprint so you know when and where to actually use it. And that's where price action comes in. This is all about learning to read what the market is trying to tell you.
You know, price action trading is a method that basically strips away all the complicated indicators and fancy oscillators. Instead, traders learn to read the story being told directly by the price movements themselves, right on a clean chart. It really is the raw language of supply and demand, of fear and greed, all laid out visually for you to interpret.
Now the simplest piece of this language is the trend line. An uptrend line, like this old one for EMC Corp, is just drawn by connecting a series of higher lows. You can see how this line acts like a dynamic floor. As long as the price stays above it, it's telling us that buyers are stepping in every time there's a dip. They're still in control.
And on the flip side, a downward trend line connects the high points. You can see it right here on this old weekly chart of Amazon. This line acts like a ceiling, or what traders call resistance. Every time the price rallied up to this line, sellers took over and pushed it back down. This shows you a really clear path where sellers are the ones calling the shots.
And this brings us to that critical moment that traders are always watching for, the break. On the left, when the price closes decisively below a rising trend line, that's a breakdown. And on the right, when it breaks above a falling trend line, that's a breakout. Both of these are powerful signals that the balance of power is shifting, and a trend reversal could be just getting started.
Okay, so trend lines give us the big picture, but what about the little details? Let's zoom in on the individual building blocks of these charts, the candlesticks.
Every single candle tells the story of one trading period. A bullish candle, usually white or green, means the price closed higher than where it opened, so the buyers won that round. A bearish candle, usually black or red, shows the opposite. Price closed lower, meaning the sellers were in control for that session.
Now, when you start putting these candles together, they form these recognizable patterns. This here is a classic double top. You see the market makes a new high, pulls back, and then tries for another high, but just fails at the same level. This is a huge warning sign that the buyers are getting tired and that upward momentum is fading. It often signals a pretty big move down is coming.
So we've looked at leverage, that's the power tool. We've looked at price action, those are the blueprints, and this brings us full circle, right back to the most vital part of the entire toolkit, the safety manual, or as we call it, risk management.
Because here's the honest truth. It doesn't matter how perfect your trend line is, or how clear your candlestick pattern looks. Sometimes the market just does not care about your plan. Events like quarterly earnings reports can completely ignore the technicals and just throw everything out the window.
And this chart of Funko is a very real and pretty sobering reminder of that. Back in November 2022, the company announced its earnings, and the stock just gapped down more than 50%.
overnight. Anyone who was holding a long position with leverage, well, they were just wiped out. This is where the blueprints fail, and that safety manual becomes everything.
And this really highlights the huge difference between a calculated risk and a pure gamble. You see, trading a chart pattern, that's a calculated risk. But holding a leveraged position through a 50-50 event like an earnings report, that's a gamble. And they require totally different mindsets and totally different rulebooks.
This all comes down to developing the right mindset. It's about building a framework of rules you just don't break. Rules that are designed to protect your capital for those times, and they will happen, when you are wrong. These are the rules for survival.
And here are the core rules you'll hear from pretty much every experienced trader out there. First, size your positions based on the risk, not on greed. Second, avoid that blind conviction. Always use a stop loss to decide your exit point before you even get into a trade. Third, you've got to be adaptable. Trade the market you actually see, not the one you want to see. And finally, learn from others for sure, but you have to build a system that actually fits your own personality.
And being adaptable is just so key. For example, trading breakouts, buying a stock when it moves above a resistance level. That is a fantastic strategy in a rising bull market where momentum just keeps carrying things higher. But if you try that same strategy in a falling bear market, it's often a recipe for disaster. Those breakouts tend to fail and just get slapped back down. The tool's the same, it's the environment that dictates if it's going to work or not.
And that really brings us to the final and most important question. You've now seen the high-powered tools like leverage and the market blueprints of price action. But the real question, the one that only you can answer for yourself, is this. Do you have the discipline to follow the rules in the safety manual, especially when things go wrong?